Good day. In this video, we are going to look at the income statement. Amanda Traders sells motor spares in a small shop located in the city center. Their financial year ends on 28 February 2021. Now, if the year ends on 28 February 2021, it means that this year started on 1 March 2020, so it is ending on 28 February 2021. That is a full 12 months. Complete the income statement, show the workings. Okay, so in the income statement, we only include the incomes and the expenses. So let's go to the incomes and expenses. So the incomes and expenses, they are in the nominal account section. The sales here is 335,000. 520. Cost of sales here is 134,208. Okay, so when you are doing the income statement, the first thing that you must do is you must take the sales and then you must subtract the debtors allowances. So the debtors allowances, they are 1,300. So minus 1,300. Minus 1,300. And then let's go to the adjustments. Adjustment number 1. Water and electricity. So let's go and look at the water and electricity. They are 1,117. Water and electricity. 1,117. So what are they saying about it? They are saying that water and electricity amounting to 544 was still outstanding. Now, water and electricity, this is an expense. So that is why we are recording it here under operating expenses, because it is an expense. Now, we are saying that water and electricity amounting to 544 was still outstanding on 28 February 2021. Now, if they are saying that the expense is still outstanding, it means that they are saying that that expense is not yet paid. So if the expense is not yet paid, what do we call that? We call it an accrued expense. Okay, we call it an accrued expense. So sometimes they may say that payable, which is the same thing as not yet paid, okay, or they might just say not yet paid, okay, or still outstanding. That is still the same thing as the accrued expense, only if they're talking about the expense account. Okay, so what do we do with the accrued expense? The accrued expense, we must add it to the expense account. So this one is for the water and electricity. So we're going to say plus 544. So 117 plus 544, that is 1,661. Okay. Number 2, Amanda Traders. Amanda Traders, it is us as a business. This is the name of the business. Rented a small office at the back of the store to a manufacturing jewelry from the 1st of October 2020. Now, this has been rented out from the 1st of October 2020, and our year ends on 28 February 2021. So this means that the rent income, because this a small office, it was rented out by us as a business to a manufacturing jewelry, meaning that us as a business will be receiving a rent income. How much is it per month? It is 3,300. Now, so this means that actually the rent income that you are going to receive is for how many months? It is for 5 months, because we started renting out this small office from the 1st of October. So it's going to be October, November, December, January, February. So that is 5 months multiplied by 2,300. That is 16,500. So actually, the rent income is supposed to be 16,500. The rent income falls under the operating incomes, 16,500, right? But then, in the right balance, they showed the rent of how much? 19,800. So what does this mean? This means that actually the business has received the rent income of the next financial year. Okay, 19,800 minus 16,500, here is 3,300. So this means that the business has received the rent income of the next financial year, which is 3,300. But the matching concept, it is saying that incomes and expenses should be recorded in a year that they belong in. So actually, this 3,300, it does not belong in our financial year. So therefore, we must go and subtract it from the 19,800 so that you are going to get the rent income that belongs in our financial year, which is 16,500. Okay, let's continue. Number 3. A debtor L was not happy with the quality of goods she bought on credit at the price of 1,017. She returned it and demanded a refund on her account. Now, when a debtor is returning the goods, 4 accounts are affected. The first one is a debtor's control. Okay, and then another one, it is the debtor's allowances when the debtors are returning the goods. And then another one, there is a trading stock. Another one, it is the cost of sales. These accounts are affected. So we are given the selling price. The selling price, it is 1,017. Now, when a debtor is returning the goods, it means that the people that are owing the business, they are going to decrease. So the debtor's control, it decreases on the credit side. And then what happens to the debtor's allowances? The debtor's allowances will increase by the 1,017. Now, let's calculate the cost price. So 1,017 multiplied by. Now, we were told here that the business uses a markup of 80%. So cost price plus markup is equal to selling price. So the markup is given, it's 80%. So the cost price is always 100%. So cost price plus markup is equal to selling price. Okay, now 1,017. So below we put what we have. So what we have is the selling price, and then what we're looking for is the cost price, which is 100%, which is going to be 565. Now, a debtor is returning the goods, right? So when a debtor is returning the goods, what is supposed to happen to the trading stock? The trading stock is supposed to increase. It increases on the debit side. And then what happens to the cost of sales? The cost of sales is decreasing by 565. So let's go and decrease our cost of sales. And then we also have a debtor's allowances, which is 1,017. 1,017. Okay. 1,017 So we know that the debtors allowances, it decreases the sales. So therefore we must go and subtract it from the sales. Okay. Now a debtor is returning the goods, right? So the trading stock is increasing. So we must go and increase the trading stock with 565. And the debtors control, they are decreasing by 1017. Okay, now let's continue. So 335, 520 minus 1.3 minus 1017. It is going to be 333, 203. And then the cost of sales 134, 208 minus 565. It is going to be 123, 643, right? So minus the cost of sales from sales, I'm going to get 199, 199, 560. Okay, let's continue. Number 4. The following stock was on hand at the end of the financial year. The following stock was on hand at the end of the financial year. They are saying that the trading stock, it is 9,980. Okay, the trading stock, it is 9,980. And then if we are comparing it with the one in a trade balance, 9.2 plus the returned one of 565. Now the trading stock, it is 9,765. Now, if we are comparing these two, this one is a bigger one. So actually, the business, they thought that they had a trading stock that is worth 9,765. But then after doing the stock take, they found that actually the trading stock, it is 9,980. Okay, so what is this? The business is winning because they thought that they had a lesser stock while they had more. So what do we call this? We call this a trading stock surplus. Trading stock surplus. So this is 9,980 minus 9,200 minus 565. So which is equal to 250. Okay. So let's add this up. Let's add this up. 16,500 plus 215, which is going to be 16,715. I'm just comparing because maybe it's not this one. 9.2 minus 565. Okay. Then now to get the gross operating income, we must say the gross profit plus operating incomes. So we're going to say 199,560 plus 16,715, which is going to be 216,275. 216,275. Then now we are moving to the operating expenses. Operating expenses. So we have the consumable stores. How much are the consumable stores? The consumable stores, they are 5,600. 5.6, right? So we are given the consumable stores on hand. Okay, so every year when the business buys the consumable stores, at that time they are treated as the expenses. But then at the end of the year, if it is found that some of them are still remaining, we must go to the expense account and subtract the ones that are still remaining or the ones that are on hand. So here we have a consumable stores which are on hand. So we must go and subtract them from the consumables. So minus 320. 5,600 minus 320. It is going to be 5,008. Okay. And then number 5, interest on fixed deposit. So the interest on fixed deposit falls under interest income, Now, how much is it in the trial balance? It is 1,125. 1125. Now, what are they saying about it? What are they saying? Interest on fixed deposit for 3 months, amount was not received. So they are saying that interest income was not received. So if the income was not received, what do we call an income not received? We call it an accrued income. We call it an accrued income. So sometimes they might say that receivable, an income receivable, that is still an accrued income. So what do we do with the accrued income? We must go and add it to the income account. Now let's go and find out how much was not received. Interest per month, it is 375, right? But then we are told that we did not receive the interest on fixed deposit for how many months? 3 months. So multiply by 3. So 375 multiplied by 3, that is 1,025. So we must go and add the accrued income, 1,125. Is equal to 2,250. The next one, number 6, advertisement. Let's go and look at advertisement. Advertisement is how much? Advertisement, it is 2,611. Okay. They are saying that advertisement amount includes 480, an amount of 480, meaning that this 480 is included in that advertising amount of 2,611. For advertising that was placed in a local newspaper for the period of 1 October 2018 to 31 March 2021. So here you're supposed to say 2020. Actually, it's wrong. It's supposed to be 2020. Okay. For a period of 1 October 2020 to 31 March 2021. But then our year ends on 28 February. Remember that. Now, actually, this advertising of 480 is actually for how many months? From 1 October to 31 March 2021. It's October, November, December, January, February, March. It's for 6 months, right? Now let's find out that how much is the advertisement of 480 per month. So we divide by 6. 480 divided by 6, it is 80 rand, right? But then our year ends on 28 February. This means that the one of March is for the next financial year. So if we have paid the expense of the next financial year, we call it a prepaid expense. Prepaid expense. So this means that the business is paid the expense of the next financial year. So what do we know? We know that expenses should be recorded in a year that they belong in. So right now, this 80 Rand, it does not belong in our financial year. So therefore, we must go and subtract it from the advertising account. So minus 80 Rand, that is 2,531. 2,531. Then the last one, let me erase this. Equipment must be depreciated at 10% per annum on the diminishing balance method. Okay, new equipment was purchased on the 1st of September 2020 for 8,000 Rand. This is the new equipment multiplied by 10%, multiplied by. Now, this equipment was bought at the 1st of at the 1st of September 2020. So this means that this equipment stayed for how many months in our financial year? Remember, our year ends on 28 February 2021. So it's going to be September, October, November, December, January, February. It stayed for 6 months. How much is that? So 8.3 multiplied by 10% multiplied by 6 divided by 12. It is going to be 415. So the depreciation for the new equipment, it is going to be 450. Alright? Now, what about the old one? Now, the equipment here, it is shown as 380,000. Now, we want to calculate the depreciation for the old equipment. But then, we were told that this new equipment, it was recorded, meaning that it's already included in this 380. Now, because we want to know that how much was the equipment at the beginning of the year, we must subtract the new equipment, which is already included in this 380 because they are saying that it was recorded. 371,700. So because we are using a diminishing balance method, we must subtract the accumulated depreciation on equipment. So minus 76,000. How much is that? Minus 76,000. It is 295,700. So multiply by 10%, multiply by 12/12 because this equipment, it was there in the business at the beginning of the year. So how much is that? 29,570. This is the depreciation for the old equipment, 29,570. So 415, it is going to be 29,985. Okay, now bad debt is 134, current expense is 102. So let's calculate them. 102 plus 134 plus 29,980 plus 29,985. 29,985. 29,985 plus 1,661 plus 2,531 5,280, 134, 102, that's 102, 141, 592, 41, 592. So it's like this. So now to get the operating profit, we must say gross operating income minus operating expenses. So 216, 275, 275 minus operating expenses, that is 74,683. Okay, then to get the profits or loss before interest expense, we must say operating profit plus interest income. So the interest income is 2050, which is going to be 76,933. Then we are going to have the interest expense. So how much is the interest expense? Interest on loan, it's 1,000 rand. So we must subtract the interest expense, which is 1,000 rand. Then we're going to get 75,933.